Welcome. Today we will be reviewing one of my favorite companies from the whole stock market, and one that I have placed at the top of my watch list so that if it ever goes on discount, or at least more reasonable valuation metrics, I will be buying as many shares as I can get my hands off because their business model and their fundamentals are just perfect. Just for you to understand the magnitude and how incredible this company is, there are only two companies in the whole stock market which have above a $1.5 billion annual recurring revenue, that are growing this annual recurring revenue above a 30% growth rate, and that in the last 12 months have generated positive free cash flow. What are these companies? Well, one of them is obviously Samsara, the company we're reviewing today, but the other one is Palantir. Are you hooked yet? Well, let's review the company then. This company focuses on the world of physical operations, and it's basically operating in a segment that has very limited competition. The key problem that Samsara is targeting is that these companies are lacking the digitalization that the whole world has gone through for the past couple of years. Now they have Samsara as the player that can link all of their operations together, digitize, obtain all the data, and just improve their operations as a whole. But how exactly is the company able to do this? Well, they have a lot of different products ranging from dashcams to telematics devices and to other kinds of sensors, which are partly included when companies subscribe to a plan. Once the hardware arrives, the company's main duty is to install the devices into their trucks, buses, or whatever they want to track. And once they've done so, well, it's that simple. You then have a full platform filled with all of your data, all of your vehicles, and all possible information that you would need in order to make the best possible decisions you can. Now, once you've done so, you can benefit in hundreds of ways. The main benefit that companies usually look for is their safety and risk features. So for example, just by using this company's AI dashcams, you're able to obtain as much visibility as you can into all the risks that your drivers could face on the road. So for example, in the image here, we can see that these dashcams track and alert whenever drivers are using their mobile phone, whenever they don't have their seatbelts on, whenever they're distracted, and over 50 more risks real time. They also have fuel and energy solutions that help companies save up on fuel, purchase at better prices, and understand which routes are ready to become fully electrified for their fleet. Additionally, they have a lot of tools in order to improve the maintenance and utilization of fleets. As we know, usually trucks are extremely expensive and they usually undergo a lot of maintenance. Whenever they're doing maintenance, well, you cannot use them, which means that you're losing revenue. Well, Samsara, through its sensors, has a lot of different tools to optimize this, improve the average utilization, and decrease the number of faults that these fleet will actually suffer. And last but not least, probably one of my favorite features is their integrations and app marketplace, where they have allowed the community to build hundreds of specialized tools using all the data and all the information collected from Samsara's hardware. But if I were to pinpoint one thing, which is what I like most about this company's value proposition, is how they're able to deliver real impact and real benefits to their clients. For example, over here we can see that they've helped DHL reduce by 50% their driver turnover. Another example, they've helped Estes save over $3 million in 1 year only using their fuel costs efficiency platform. Or what about the last one? The 81% reduction in collision risk within 6 months of installing their hardware for the city of New Orleans. So these are incredible benefits from real clients that are being used to sell this value proposition to new customers. And once you see these benefits, well, it's extremely easy to upsell and cross-sell all of your different features. But I know what you might be thinking. This is just another software as a service platform. This will be potentially replaced by AI in the future. Their only real value is in their hardware collecting data. But let me prove you wrong. Currently, Samsara has one of the world's largest operational datasets from non-publicly available information. Because the routes that are traveled, the fuel efficiency, general fleet information, that are completely unique to each one of the devices that they have installed at the moment. And as such, they currently have over 14 trillion data points, which has grown at a 50% year-over-year growth. Why is this important, you may ask? Well, because they're leveraging their own AI in order to provide specific solutions, recommendations, and give key insights from information that is completely tailored to each customer and which is not publicly available, so a general Gemini or ChatGPT would not be able to provide these companies with this level of help. And this is exactly where the company's economic moat actually emerges from. They have incredible products, which is how they were able to obtain a lot of customers. By obtaining a lot of customers, they're able to retrieve and store and use a lot of data points. And the more data points they have, well, the better they're able to make their products. Because they'll be able to create more products, these will provide better recommendations, and these will have a lot more depth. Another incredible feature that emerged from this network effect, which is impossible to break at the moment, is the weather intelligence. And now this seems extremely easy. It's just publicly available information. You purchase it from satellites and you have it straight on your dashboard. But Samsara goes one step further. They even have a functionality which allows the manager or the route planner to access onboard cameras from trucks which are not from that specific customer, but which have a specific Samsara device connected. So for example, if DHL is planning on a route from Chicago to New York, but they know that there is a thunderstorm coming, the route planner can access one of Amazon's trucks, which may have Samsara's device connected, and look at the onboard camera to see how the weather is looking on a specific road. And this has been going on quarter after quarter. They just seem to find hundreds and thousands of applications to unlock and to keep developing with all the data that they are actually retrieving and to increase the value that they're offering their customers on pretty much a daily basis. And this is incredible. And the next best thing, well, all of their revenue is recurring. They sign 3 to 5 year contracts, they get paid on a monthly basis, their price per application and per device, and they have incredibly high retention rates. And I could keep going on and on and on about this business because I have just fallen in love with it. However, we have to move on to the financials because they're also very important, and it's the best way to understand that even if a business model is good, are they really executing and benefiting from the incredibly high quality business model that they have? But before that, I want to remind you that we have analyzed Samsara under the compounder score, which is the checklist that we use in order to rank companies and see whether we should invest in them, analyze them further, or just ignore them and keep them away. And now for those of you who don't know, this is what we do on Substack, which is our written content platform where we do all of the research we normally do in order to prepare our YouTube content, which means that this is usually more in depth. And also it's like a financial Twitter where we do a lot of different posts and we share ideas from fellow investors. So check it out in the link down below because it's completely free. So let's start with a quick financial summary. Samsara is not profitable yet. Their revenue is growing at an extremely fast pace and their net margin has been expanding every single year as well since 2020. As if this weren't enough, the company has an incredibly strong balance sheet where only with their cash and cash equivalents, they can almost cover their total current liabilities. If we were to compare their liquidity, so just their current assets minus their current liabilities, they have a lot of wiggle room if they want to make investments, if they want to return capital to shareholders, or anything else. And our favorite thing, as our channel's name suggests, is the company's free cash flow predictability and stability. Here we have the past 6 months, which have all been positive, by the way, and we can see that the company's free cash flow is extremely predictable, trending around the median, which is around $38 million per quarter. Now, from the compounder score, there is one only thing that I found a bit worrying about the company, which is that the total shares outstanding is actually rising every single year, which, although it's rising at a pretty small percentage, when you compound this over time, the share count growth can be explosive. So for example, from 2022 to 2025, despite the average share outstanding growth being a 3 or a 4%, this has made their shares outstanding go from around 500 million to around 570 million. So that, in small increases, is almost a 15% increase in the number of shares outstanding. However, this is an industry-wide problem because it is mainly generated by share-based compensation. And at the moment, since the company is able to grow its revenue and its bottom line way faster than the dilution rate, then we can consider it acceptable. Additionally, as we can see that the shares outstanding growth has been decreasing year after year, this gives us a bit of hope on the fact that management is actually tracking this and focusing on reducing it. But now we get into the interesting part, and the part that I don't enjoy that much, which is their valuation. Since they're not profitable yet, we're going to be looking at their forward price to earnings ratio instead of at their normalized price to earnings ratio, and we can see that currently it is trading at the lowest it has been trading at since early 2024, so in the past 2 years. However, they're trading at a forward price to earnings ratio of 73 times. Now, just for you to put this into context, an extremely high quality, growing company such as Google only trades at a forward price to earnings ratio of around 27 times. So Samsara trades at almost 3 times Google's valuation at the moment. Of course, I understand that Samsara is growing at a much faster pace, their revenues are mainly recurring, and they're more resilient to economic downturns. Does that really justify a valuation that is 3 times one of the best companies in the planet? At the current valuation, it feels like there is no room for error on Samsara's execution. The thing that scares me and is not allowing me to purchase some shares at the moment is the fact that I believe that if Samsara has just 1 quarter that is offbeat and they grow by just a little bit less, or their margins contract because of some external factors, their stock will be forced to reach valuation multiples that it has never seen. And on the other hand, if we look at the company's free cash flow yield, it is now trading at a yield which is the highest it has ever been trading at. But this makes sense because the company is also generating the most amount of free cash flow that it has ever generated. As a rule of thumb, we usually consider that a free cash flow yield of around 3%, or whatever a long-term reasonable bond yield may be, is a company that is trading at around fair value. Now Samsara is trading at a 1%, which is okay and pretty good for a company of its growth rate. However, it still tells us that the company is trading at a pretty hefty premium. Just to compare it once more against Google, Google is currently trading at the lowest free cash flow yield it has traded at since 2016. This means that it is the most expensive it has been in a very long time. This, on the one hand, has to do with their insane bull run, which we called out around 8 months ago, by the way, but it's also because now they have the highest capex they have ever had, which is something that decreases the company's free cash flow. Now, since Samsara has been free cash flow positive from not so long ago, I don't think that this is the perfect valuation measurement, as I believe that it will still keep rising in the following quarters as they will generate more and more free cash flow due to their immense growth rate. However, we have a very simple discounted cash flow valuation which may define if the company is fair valued at the moment or not. So now, as we've seen, Samsara trades at a free cash flow between 1 and 1.3%. According to the assumptions that we've used, if the company were to trade at the same free cash flow yield in 5 years, well, the expected investment annual return would be a 25%. However, if we expect the growth rate to slow down and valuation multiples to contract for the company to trade at a more reasonable 2.5 or 3% free cash flow yield, then at the moment, the expected investment return is under 10%, which is not something we want to really pursue. Before diving into the numbers, just remember that discounted cash flows are not something we should rely on blindly, as these are extremely sensitive to changes in our assumptions. But just for the sake of conducting the discounted free cash flow, these are the assumptions that we have made. We're assuming a 19% annual revenue growth, which is just below the 22% expected from analysts. We are estimating that the operating cash flow margin will increase to 15% in year 2 and to 17% in year 3, but we're expecting it to remain constant as they invest more heavily due to potentially higher competition in the upcoming years. Now, this is extremely conservative, but we prefer to do valuations in that way. And last but not least, again, to fend off competition and due to their increased investment into AI features with the geographical expansion, we're estimating that their capex as a percentage of revenue will increase from the current 2% to a 4%, which will be maintained throughout the 5 years. And since the company has to retain top talent, we're assuming that the shares outstanding will keep increasing at around 2% every year for the following 5 years. So just as a conclusion, I believe Samsara is one of the strongest businesses I have ever reviewed, with one of the best offerings in the stock market. However, Its current valuation makes the company look as if it were priced to perfect execution. We're currently staying on the sidelines, but this company is number 1 in our watch list. Thank you for watching. I hope this was useful. Remember to check out the Substack down below because you will get a lot of value. Everything there is for free, and I'll see you in the next one.